All right, welcome to this explainer. Today, we're going to dive into a really fascinating, highly detailed source that unpacks the incredibly complex reality beneath India's headline economic numbers. You know, we constantly see these bold, super optimistic statistics flashing across our news feeds, right? Well, the material we're looking at today asks us to take a step back and look a little deeper. We're going to treat this like a giant iceberg, basically looking at what's proudly displayed on the surface versus the massive reality hidden right underneath.
So here's our roadmap. We're going to tackle this in 6 quick parts: the GDP paradox, the job and wage crisis, debt-driven consumption, 3 global shocks, inflation in the rupee, and finally, government debt and the outlook. Let's just jump right in. Okay, Section 1, the GDP paradox. So, right at the tip of our iceberg, we hit a massive contradiction. On paper, official figures are boasting a ridiculously robust 8.2% GDP growth rate. I mean, that is the hallmark of a booming economy for sure, but our source points out a really sharp contrast. Back in a May 2026 rally, the Prime Minister actually urged citizens to adopt some pretty strict austerity measures. He specifically asked families to cut their cooking oil usage by 10% just to save the country's foreign exchange reserves. Now, you might be wondering, if the economy is literally growing at over 8%, why the sudden urgent need to ration basic household goods? It's a pretty confusing juxtaposition.
Well, to figure that out, we have to look below the surface. Section 2, the job and wage crisis. You know, macroeconomic data can sometimes feel super detached from our actual lives, so the source material really brilliantly humanizes this through the story of a guy named Alpesh. Alpesh is a diamond worker over in Surat. He had worked his way up, making a very stable 35,000 rupees a month, which was enough to send his daughters to a private English medium school. But when his industry crashed, his pay was slashed, and eventually he lost his job entirely. He was forced to take menial work for just 12,000 rupees a month, and literally had to pull his kids out of private school just to survive. This is the real human cost when these major industries falter.
And Alpesh's story? It's not an isolated incident. Zooming out, the source points to a rather quietly released government report showing that 2.7 crore, that's 27 million informal sector jobs, just vanished. And get this, that happened in just the first quarter of 2025. 27 million jobs in 3 months. The informal sector is absolutely crucial. It's the backbone of employment for the vast majority of the country. So when work evaporates like that, it really exposes a deep underlying fragility that those top-line GDP numbers simply ignore.
But what about the people who actually kept their jobs? Well, the International Labor Organization data presented here shows a really concerning trend. Over a 10-year period, inflation-adjusted real wages have actually gone down. Check this out. In 2012, a regular salaried worker made an average of 12,100 rupees in real terms. But by 2022, that purchasing power had shrunk to 10,925 rupees. So sure, people might be seeing bigger numbers printed on their paychecks, but the actual value of what that money can buy at the store has definitively dropped.
Which brings us to a huge, glaring question. Section 3, debt-driven consumption.
Think about it. If real wages are falling and literally millions of jobs are disappearing, how are we still seeing people out there buying new phones, luxury goods, and appliances? The source argues this surface-level consumption is heavily fueled by debt. Household debt to GDP has climbed to over 41%. Now, taking on debt isn't always a bad thing if you're building an asset, like buying a house. But the kicker here is that over 55% of this debt is made up of non-housing retail loans. We're talking personal loans, maxed-out credit cards, EMIs for smartphones, ACs, TVs, the whole shebang. People are burning through their savings buffers to maintain their lifestyles, leaving them incredibly vulnerable.
And as it turns out, that vulnerability was tested almost immediately. Section 4, 3 major global shocks.
This highly leveraged domestic economy got hit by a cascading timeline of international crises. It's like a chain reaction. The analysis notes it started in August 2025 when the U.S. slapped steep 50% tariffs on Indian goods. Then, in February 2026, intense geopolitical pressure forced India to abruptly stop buying the cheap, discounted Russian oil it had come to rely on. And if that wasn't enough, right around the same time, between February and April 2026, war involving Iran led to the closure of the Strait of Hormuz. That's a massive artery for global trade, and its closure caused absolute supply chain chaos.
And these global shocks hit local jobs hard and fast. The source outlines the devastating fallout in key export hubs. Down in Tirupur, a massive garment hub, their products suddenly faced crippling 64% combined duties. That threatened up to 150,000 jobs. In Surat, where our diamond worker Alpesh is from, the industry suffered massive layoffs and, tragically, a spike in worker suicides because of lost raw materials and completely collapsing demand. Meanwhile, the shrimp export industry, their orders just completely dried up. These aren't just statistics. These are entire regional economies being hammered.
So mix a fragile, debt-laden consumer base with massive global trade shocks, and you get Section 5, inflation and the falling rupee.
Here's where things get kind of weird. There's a glaring discrepancy between the official data and what's actually happening on the street. The official retail inflation number sits at a very comfortable, manageable 3.93%. Sounds totally fine, right? But wholesale price inflation was bubbling at a 3-year high of over 8.3%. The analysis points out that for everyday people, the reality was much harsher. Thanks to those global shipping blockades we just talked about, black market prices for basic necessities, like domestic gas cylinders, were reportedly skyrocketing way past the official government rates.
And making all of this so much worse is the collapsing value of the currency itself. In May 2026, the Indian Rupee hit a historic, record low of 96.90 against the US dollar. Why is that a big deal for us? Well, India imports almost 90% of its crude oil. When the rupee tanks against the dollar, every single drop of that imported oil, every machine part, every bag of fertilizer instantly becomes way more expensive. And that just throws gasoline on the inflation fire.
Now, normally a country tries to defend its falling currency by attracting foreign direct investment, getting foreign companies to bring dollars in. But the data here is honestly pretty stark. Net FDI practically fell off a cliff, dropping from $43.9 billion in 2020-21 all the way down to less than $1 billion in 2024-25. Plus, the source highlights that foreign investors actively pulled out a staggering 2.7 lakh crore rupees from Indian markets in just half a year. The financial safety nets were just vanishing.
Which naturally brings us to our final stop. Section 6, Government Debt and Outlook.
Usually in a textbook economic crisis, the government just opens up the treasury, right? They spend money to stimulate the economy, build things, create jobs. But the source argues that's basically impossible right now. Let's look at why. When you break down the government's revenue, 25% of it goes instantly out the door just to pay the interest on old debts. Add in 28% for government salaries, 15% for pensions, and another 15% for mandatory subsidies. That means over 80% of total revenue is completely locked in before the government can even think about funding a new project or bailing out a distressed sector. The Treasury is essentially tapped out.
And the big financial players are definitely noticing this drained treasury and the crazy high oil import bills. Organizations like Morgan Stanley have actually downgraded India's growth forecasts to 6.7%. Also, that highly publicized, super ambitious goal of becoming a $5 trillion economy by 2025? Well, SBI Research cited in the source quietly pushed that milestone all the way back to 2030. To really sum up the gravity of all this, the explainer cites a financial journalist Debashish Basu from the Business Standard. He said, India is entering a phase where the margin of error has vanished. That is a powerful way to frame it. Basically, with sky-high government debt, consumers maxed out on loans, a battered currency, and total chaos in global trade, the economic shock absorbers are gone. Every single policy decision from here on out has to be perfect because the stakes are incredibly high.
And that brings us full circle. It really forces us to look past those shiny top-level numbers and confront the messy, complex reality underneath the surface of the iceberg. So I want to leave you with a critical question to think about. With these global headwinds intensifying and our domestic financial buffers basically depleted, how is the nation going to navigate this unprecedented economic storm? It's something that impacts literally millions of livelihoods, and we should all be paying very, very close attention. Thanks for joining me for this